going along. So before we get started, does anybody have any questions? Okay, guess I'll give real quick. My name is Lisa Watkins. I am the finance practice manager at Bales, and I have been working with the Lawson products since 1997, started as an end user, and have been in the consulting world since 2005. I'm sorry, 2005. So over the years, I've come across, challenges with the supply chain conversions and the finance, and couldn't really get an understanding of why we seem to have so much difficulty in planning for this. And recently worked with my counterpart, Casey Burge, the supply chain practice manager at Bales. And we got to talking and working through some of these challenges. And I taught her some accounting. She taught me some supply chain, and we were able to put this together. And so hopefully you'll find this beneficial to all of you. So I do want to do a disclaimer. This is related to upgrading to version 11. Although this is not typical, this presentation is not meant to show you how to do the conversions, it's planning for them. This is for informational purposes only. We're not going to tell you which way you need to go based on a conversation today. This is just to give you the things to consider and to discuss with your consultants when you're involved in the project. So, can't stress enough that we want supply chain conversions need to be coordinated between finance and supply chain, since the decisions made by the purchasing and IC area impact accounts payable in the finance department. The level of effort for each department needs to be considered. A decision made by one side typically ends up with a burden on the other team because it wasn't considered all the way across. Bales and I recommend reviewing the options as early as possible. I don't know if any of you are in the process of doing a implementation or an upgrade, but the sooner you can talk and consider it, the better. So what are some of the challenges with supply chain conversion? Number one that we hear from our clients is getting clean data from the legacy system, whether that is Lawson Infor or if it's a different product. It seems like you get purchase orders that are created that end up staying in an open status, and difficulty with receiving or difficulty from payable side in matching the proper PO. And we have a lot of purchase orders that may need to be cleaned up. If you're in the Infor world at this time, then, the data, we are familiar with the forms and the programs, but some of the implementations we've done where we've worked with other products, the data in the system may not have some information, or the way they process it the same as it is processed in Infor and in Cloud Suite Financials. So we have to be considerate of that when we're looking forward. So as we all know, we can have discrepancies between an invoice and a purchase order and its receipt. So existing buyer and recon messages and how we're going to be able to handle those and what we do with them is going to be important, because they impact the status of that purchase order and receipt line based on what type of messages we have. Another key note, and this is one I fought for years and I couldn't understand why not. Those of you that are financial people and have gone through conversions may have seen this before, but in financials, we normally have a flag that says do not impact the GL, because we're going to convert GL balances separate. Inventory items cannot be converted without impacting the global ledger. So you have to have a plan in place to accommodate that, to address that, because more than likely you will also be converting your GL balances, which will include those inventory items. In Cloud Suite Financials, all POs are going to be assigned a new Infor PO number, so we can't bring over the legacy one. We can put it into a reference field, and there will be a built-in crosswalk by doing so, but it will not be, we can't bring it over as it used to be. Those of you that are existing Infor users, if you're using the PO codes, typically what I've seen is that a PO code will be used to identify a blanket or a service type, or perhaps capital, and you would use that code, but in S3, it gave you the ability to also start a different numbering sequence, which made it easier for payables or other people to identify what type of purchase order it actually was. While PO codes are still available in Cloud Suite Financials, they do not allow you to do smart numbering based on that code. That's a big change for us as well. The item type from your legacy system may be changing in Cloud Suite depending on if you're going to implement contract management. So typically the services, are they going to be on a PO or are they going to move to a contract and do service contracts? Just something to keep in mind. So before we go into the options we have and some of the challenges, I want to put some assumptions out there and some definitions to make sure we're all on the same page. So the converting open POs and receipts should be completed before full physical inventory to reduce the need for adjustment. This is assuming that you have inventory items on your open POs and open receipts that would have already been impacted to the GL. Converted inventory items will have the date of the conversion. You cannot add items into the past. And we also assuming during the conversion that the structure relations will remain on, meaning you will already define your valid accounting unit relationships or what your future dimensions will be. This ensures that the data that you convert for the supply chain will meet that criteria and you won't end up with error suspense after the fact. So definitions, an open PO line, and I am not in any way making these statements on definitions because I don't think people understand, but I have learned over the years that what one area considers open and another does is different. And not only what areas, but different levels in the organization. Typically we see, the statement of work is defined and has a statement about how the conversions will be done, and what it says on that statement of work that was defined by higher ups in the organization is not what the end users would think it is. So I wanted to start with saying that, an open PO line could be for an item that has not been received, or it's an item that has been received but not yet matched. Open receipts are items that have been received in the system but has not been matched to an invoice. I'm going to stress on that. When we're using the term open, this is what I'm referring to. Any questions? Okay. We're going to go over some of the conversion options we have. I can call this one a full conversion. Convert all open POs, even if not received, and open receipts. This is typically what I will see in a statement of work, that it'll say that we are going to convert open POs and open receipts. And then when we get into the process, we find out, no, they didn't mean the ones that were 10 years old that are still open. So this is all. So there's going to be pros and cons for each of these. Obviously, the pros on doing this cutover is going to be clean cutover of legacy data. The received not invoiced GL balance will tie to your conversions because you've brought all open receipts over. The effort is prior to go live. You're not going to carry over the effort through subsequent periods after go live. For POs that have partial receiving at the time of cutover, we'll have the ability to have both converted receipts and the new receipts on the same PO. The cons on that, of course, is the level of effort to get the clean data out of the legacy system. I'm going to go back to those open POs that don't have a financial impact in your current system. Maybe they didn't have any receipts, but the PO itself is open with lines. It's not causing any issues. It's so old you just ignore it. But now we have to identify it to only get what we need out of it. So we're doing all of it. We may have hundreds or thousands extra POs that you really don't want to convert. The amount of time we're going to have to map the distributions for all of those purchase order lines to the proper GL objects. And the GL structure must be finalized before this process is started. So that one is pretty much going to be a continuous that we are going to have to map our distributions if you are taking advantage of the new functionality or taking the advantage of the opportunity to redefine your system instead of a lift and shift of your current setup. A partial conversion would be to convert open POs that have open receiving only. So that's going to give us a smaller number of PO conversions to deal with, and we won't have to go in to clean up old open POs that have not had receipts. We're just going to bring over the ones with the receiving, which had GL impact. Again, the GL impact will be addressed at go live without carrying over to subsequent periods. The legacy received not invoice report can be validated against the converted items. So it's going to be sure that we captured everything and everything made it in. Again, the level of effort to get clean data out of the legacy system, the amount of time to invest in the distribution. But now we're also going to have another con on the partial, because resources must be available after go live to manually build POs for receipts that come in without a converted PO, and or updating existing POs that were converted for receiving. I'm going to give an example here. I have a purchase order that has 10 lines on it, and I have received 5 lines and no invoice yet, and the other 5 have not. Converting only the ones with open receiving would mean I'd convert only those 5 lines. So now a week after go live, I get the receiving in for the last 5 lines, and they're not available in the system to receive. So the buyer will need to go in and add those lines so the receiving doc can receive those items. And then the last one, because this one has to be done. I don't see any way around it, getting these inventory receipts into the system. This is where you would only create open POs for the inventory receipts. So there's a lot fewer to convert. That's about the only advantage you're getting on this. Again, the level of effort, and then the distributions. But the ongoing manual process that's going to happen for AP and receiving for all of those other items that are out there. Okay, so we're going to go through what the manual process is later on. I just want to stress our different conversion options we have. Any questions about the conversion option? Okay. Let's talk about some of these manual processes, and you guys might be able to even share some additional ones, but I have seen a variety of them in my years of experience, but it's certainly not an all-inclusive. The considerations that we need to have about doing the manual processes. So if you recall, the only one that's not going to require any kind of manual process is if you do convert all open POs and receipts. You're not going to bring over all the open receipts. Then the R&I balance, which is the received not invoiced balance maintenance, you're going to be closing receipts in a legacy system, or you're going to have to use spreadsheets. How are you going to maintain it to get that proper financial reporting done? If you're going to be receiving for old POs, where is this done? Are the POs built as they're needed? Invoice entry, how are you going to how to perform a manual match? If I didn't bring over all of my receipts and my invoice comes in, am I going to manually look something up to make sure it matches? And then the time it takes to do mapping of distributions for that invoice if you didn't bring the PO over, or from a spreadsheet, how will that work out? And how long will my legacy system be available if I haven't converted everything over? These are some of the things you want to keep on your radar to talk through and identify your process. Okay, so one of the manual process, build POs and receipts and info after go live as the invoices and receipts are received. In my experience, this is the most common process used by clients that choose not to do a full conversion. The problem with this is you're not saving any of the effort, you're just shifting when the resources will be needed. I can tell you in my experience as a finance consultant who stays on until the first GL close, is I'm generally there with the client beyond the first purchasing close, which happens earlier in the month. And I see AP is the one that ends up with this burden towards the end because the invoice isn't getting paid. So we're waiting for a buyer to have the availability to process the receipts or build the PO for us to be able to enter the invoice. And now our payment may be delayed, and now the vendor can be putting us on hold. Working in legacy to validate the three-way match. This option is typically, in my opinion, a drain on all resources involved. Users will need to utilize both the old and new numbering schemes, the distribution. If the invoice does not match exactly, then the messaging is going to be done external from the system. There's not going to be an audit trail in the system. And again, it'll cause a delay in processing invoices and can result in being put on hold by the vendor. You will also still need to process to manually reconcile the received not invoiced balance to bring into the Cloud Suite financials every month. Working from spreadsheets to validate three-way match. This is another one I see quite frequently. This has the same challenges as working in legacy system, but except for the fact that you can have the distributions already mapped. But it also adds an additional risk that the file can become corrupted or users won't update the sheet as they use the receipts. Human error can occur by selecting the wrong line of the spreadsheet, and it can make it difficult to calculate the true remaining received not invoiced liability. So here's where I'm coming in with my financial impact. Perpetual inventory valuation. Typically, your financial balances are converted, and that would include your inventory balances. Your inventory, however, your inventory cannot be loaded into Cloud Suite or inventory receipts converted without creating entries to the GL. So you need to develop a strategy for converting and test it throughout the project. We recommend that the inventory GL balance is validated by finance before the system is turned over to the supply chain users for additional processing. That is to ensure that your inventory valuation, after you have converted any open receipts and loaded your physical inventory into the system, that your inventory valuation ties to your GL before processing begins. It is extremely difficult once the processing begins to identify the transactions that occurred due to the conversion versus day one of processing. The received not invoiced liability. So I'm not sure on the call if everybody is familiar with how that balance is calculated. So I wanted to make sure that it was included in the presentation. For inventory items, and I need to add a disclaimer here too, this is the process in Lawson/Infor, how this happens. I recently worked on a project where another system did not calculate this R&I the same way that we did in Infor. So I am referring to the Infor way of calculating it. For inventory items, when the inventory items are received, they debit the inventory account and credit the R&I account assigned on the match company when the receiver is released and inventory is journalized. In S3, that's when the IC 130 is run. The liability is going to be relieved when the invoice is processed. For all other items, the special and non-stock, I shouldn't say all, the special and non-stock items during the purchase and close process, an accrual entry is created that debits the expense and credits the R&I account. This entry is then created as an auto reversing entry that will reverse in the following month, and then during the next month end close, it'll go through the same process again. Service items, which are not goods, which are not received, will not impact the received not invoiced liability. So the inventory has to hit to the inventory account upon receipt rather than in credit the R&I, because the inventory items, by the time we get the invoice, could have already been expensed and distributed out to the users well before we have actually paid for the good. That's why this one's a little different. Okay, so we want to make sure we define the best process for ensuring that the conversions will reflect what the ledger balances were prior to go live or determine acceptable variances with explanations for the auditors if the need should arise. If my received non-invoice liability is $2 million at the end of the period in my legacy system, and I don't convert everything over, and I just start fresh on the new, and now my liability in period 1 on the new system has dropped by $1 million, that can certainly cause a flag to the auditors if something is a drastic difference. So understanding what's an acceptable variance certainly comes into play. A lot of clients will use this opportunity. You know, we have some old R&I items that go way back and they're small dollar amounts, and the level of effort to clean them up may be more than we have the time for. So perhaps the finance department or auditors can say, you know, we're okay with that. It'll have a, you know, X dollar amount change that's explainable, and we just document it ahead of time. Okay. So my takeaways for this is to discuss and define the conversion plan early in the project. Define the scope of conversions and communicate with all users. And build the time into the project plan to allow for the testing and validation across the suite. And of course, we want to begin cleanup as soon as possible to minimize the issues. I'm going to stay on this for a second and just give a little bit more to it. I mentioned early on that it's what's on the statement of work is really what your consulting team is working towards, is whatever has been defined as an organization. I cannot tell you how many times the statement of work said open POs and open receipts will be converted. And then we get halfway through the project or close to go live and find out the supply chain was like, oh no, we weren't planning on bringing those over. Or supply chain says, yeah, we're going to do this and we're going to use an Excel spreadsheet, but not having communicated that to finance. Well, again, the AP staff needs to be able to ramp up so that they can handle that increased workload, because it is going to take them longer. I also highly recommend you define it early and test it early. How much data cleanup is going to be needed, it's going to be able to be identified a lot sooner if you can test the conversion process sooner in your project plan. Okay? And we don't want just to have the conversion process full time allotted to the other areas to validate that before other testing goes on. So for example, we do the, do our build, we do a conversion, and then we have a little period of time for validation before we're going to start using that data for testing. So in the supply chain validations, perhaps, supply buyers are going to be looking and say, oh yeah, I got my POs and my PO numbers tie out. Well, if we don't allow time for the financial team to look at that, look at those inventory valuations, look at those reports and compare them to the GL balance, we may not catch something that could be wrong in our mapping or in our conversion process that we can correct earlier in the project than at go live. I cannot stress enough the emphasis on collaboration between finance and supply chain out the project. I started this presentation by saying I worked with my counterpart Casey on this project, and we really identified, there's no one way it can be done. We have to work together on this if we want to have proper financial statements. It is not accounts payable's fault when a vendor gets put on hold after go live, but they always feel that pressure. They got the volume, they got to get that payment out. But if they can't get the data in there, it is not the buyer's fault that somebody made the decision that they're going to be able to drop everything and create a purchase order for a receipt that's coming in, day one that wasn't built beforehand. All of the options that we looked at can be used and can be successful. The key to that is planning it as an organization and staffing it appropriately. Okay, we're going to do it this way, then we need a buyer that is sole responsible for X period of time to do this. Or we need AP to have additional staff on hand that can do some mapping for us. Things like that can mitigate Any questions, any comments, any experiences anyone would like to share? I'm getting
Nothing in the chat, Lisa.
okay. Can I ask, is anybody going through the process? Do we have anybody on the call that's currently in the process or getting ready to? Okay. It's a Friday afternoon, I totally understand. All right, so I would like to bring up a couple of things. So if you're kind of shy or just didn't want to discuss it on this call directly, Bales is offering a new service of consultants. If you want to talk with a Bales consultant one-on-one to ask a question, view a particular system feature, you know, I don't really know, I just want to talk this through type of thing, visit us at bales.com and send us an email through our website by selecting the Reach Us and put in your request for it, and someone will get back to you and schedule a time with the. I also want to point out we have a couple of upcoming seminars for next Friday. I know you'll be disappointed. We don't have a finance one next Friday, but we do have a phased approach to Invoice Human Capital Management suite of products. And we have one on a beginner's guide to IPAs from our technical staff. Hopefully you're able to join us on those. And that is all I have. I appreciate everybody's time this afternoon. I'm still available if you have any questions.
Thank you, Lisa.
Thank you, Brian. Have a good day, everybody.
Thanks,
You
Lisa.
too.
Thanks, Lisa.